Let's turn now to Brian Nick to talk more about the Fed and the markets. He's Chief Investment Strategist at Nuveen. Brian, thanks for joining us tonight.
Thanks for having me.
As you heard, the guessing game has hit a new level today. It's either 25 or 50 basis points, according to Morgan Stanley or Bank of America, but everybody seems to feel that by the end of the year, rates will be 75 basis points lower than they are today. What's your guess?
Yeah, I don't think it's going to be necessary for the Fed to go 3 times with rate hikes this year. I think what's been priced in pretty solidly.
Rate cuts, you mean?
Rate cuts, I'm sorry, of course.
We're so used to that now.
We're only 6 months removed from rate hikes,
Yes.
so I'm still adjusting to the new reality here. So we do think they will go at the end of this month. If Chair Powell wasn't intending to cut rates at the end of this month, he would have had to say so today, and he obviously didn't. And then the very high likelihood that they'll go again in September, and then probably pause. And the hope, I think, on the Fed's part and on our part is that by the end of the year, some of the risks that the Fed is concerned about will have dissipated, that global growth will be showing signs of being on the upswing, and that at least some of these sources of policy uncertainty, whether it's the debt ceiling or Brexit, or even a potential deal on the U.S. and China on trade, at least those risks will not have gotten worse, and that they'll feel comfortable that they've done enough.
So, but the equity markets the rally in the equity markets have been to a certain extent built on the expectation of those rate cuts. What's your outlook of equities if indeed we do get that cut in July?
Yeah, so the stock market in the U.S. is up about 20% year to date. Our mid-year outlook is to expect a tougher climb. That's particularly true of, we think, U.S. stocks, which we don't think are poised to give anywhere near the returns they did in the first half of the year, because once these rate cuts are sort of priced in, that's the market basically saying, look, we need some help from the Fed. We think we're going to get that help. And even if the Fed follows through and does cut rates 2 or even 3 times, it's going to be hard for the markets to rally further, especially given the fact that what we're concerned about in the next couple of quarters is a very soft period for corporate profits. And at the end of the day, if corporate profits aren't growing, there's only so far the markets can travel upwards.
And then there's the story the bond market seems to be telling as we continue to see yields go lower there to in some cases 3-year lows. How do we reconcile that with what the equity market's been doing?
It's not typical that you have a prolonged period when bonds and stocks are rallying at the same time. And that is, again, another reason why we're very cautious about the second half of the year for both fixed income and for equities, because this correlation probably isn't going to last. It's going to resolve in some way, probably with interest rates rising moderately. Again, keeping that optimism alive for the end of the year, with growth looking to be a bit better by Q4, which means the interest rates should go up a bit. But also, the reality of corporate profits and where valuations are probably limiting the degree to which stocks continue to move up. So we're looking at flattish returns for the rest of the year in stocks, flattish for bonds as well. Fortunately for investors, the first half of the year was very good.
Indeed. Brian Nick with Nuveen again. Thanks for joining us tonight.
Thanks very much.